Hello, Ashley and I are here today with Will Hale. He's our financial advisor and CPA, has been for a very long time, since the early 2000s.
Yes, we're so glad to be here with you today, Will. Why don't you tell us a little bit about what you do and who you typically work with?
Well, Ashley, thanks for the invite. And I'm a CPA and certified financial planner, and I have 3 businesses that operate out of this office. The first being a traditional accounting practice where we do tax, bookkeeping, payroll, compilation review, and consulting. The second business is a financial advisory business where we manage brokerage accounts and retirement plans and that sort of thing, and offer all kinds of investments, a broad spectrum of investments from CDs to stocks to bonds to mutual funds, and we even do annuities and life insurance. And then, of course, we have a third business, which is a commercial cow-calf operation.
So a lot of folks ask about 1031 exchanges, and I'd like to understand a little better for families who are looking to right size out of the family farm. How does a 1031 come into place versus what happens with the residential side of the property?
Yeah, so when we have a family property that is the primary residence, but is also a business property, it's a farm or a ranch, then when that transaction happens, the transaction gets bifurcated. It gets separated into 2 transactions. One transaction for the sale of the residence, and one transaction for the sale of the property. Those might be combined on paper at the closing, but on the tax return it gets separated into 2 so that we can take the house and an acre and apply the home sale exclusion based on a broker's opinion or on an appraisal of that house and an acre, and then the rest of the transaction goes to the ranch or the farm real estate. And when it comes to 1031s, 1031s are a tax deferral plan. It's a tool to defer tax. And the way 1031 works is that before you even sell the property, you put as the seller on the property an exchange agent, a 1031 exchange agent, meaning my intent is to not receive the proceeds from this transaction. Instead, when this transaction closes, the proceeds are going to go to an exchange agent to be held in escrow. And then I'm going to find another property and I'm going to invest all those proceeds in a replacement property or properties, and therefore not recognize the gain on the first property, because I'm basically just taking my basis in that first property and moving it over here and applying it to the replacement property or properties. And 1031s do not apply to your primary residence. So you can't 1031 your house. But if it's a business property, whether that be rental, farm, ranch, or commercial, 1031s are a way to defer the tax by saying I'm not going to pay tax on it now because I'm going to reinvest that money immediately into another property. We need to know ahead of time that you're going to do a 1031. So that the agent can be listed as the seller on the contract, and that funds can go directly to them, because you cannot touch any of the funds or else it becomes taxable to you. Second thing we have to keep in mind is within 45 days of closing on your property, you have to have identified the replacement property or properties for the exchange. And then in 180 days, you have to have closed on the replacement property. It's a great tool. It's usually a tool that comes into play when we have a very large built-in gain. We have a piece of property that's appreciated substantially over time, and we have a taxpayer who intends to hold real estate for the rest of their life, because they get to hold that replacement property then all the way through probate, get a step up in basis, and we've avoided the tax on the transaction. If you intend to sell the replacement property, you've just moved the tax from the current year to whatever year you sell the replacement property or properties. So yes, does it work good? It does. But like you say, it's really a deferral method more than an elimination technique. Another thing to keep in mind too is that there are 1031 funds available. If you have an older couple that they're like, hey, we don't want to pay tax on this transaction, but we don't want to own real estate. We're tired of dealing with tenants, or we're tired of dealing with cattle, or we're tired of farming. We have the ability to take and invest that in a 1031 fund, that acts exactly like a replacement property.
So Will, when people are considering a 1031 exchange and starting to look at their options for replacement properties, you mentioned that you can have up to 5, and that may seem a little overwhelming for some folks. You also mentioned the exchange fund as an option. How does that work, and when should that come into play if they want to contemplate moving into a fund like that?
So normally the fund comes into play when you have a property owner who wants to do a 1031 but doesn't really want to own property outright. And so during that 45-day period after you've closed on your transaction, you have to identify the 5 replacement properties. And we normally encourage a taxpayer to include a DST or a 1031 fund on their list if they're at all interested or think that that's a possibility. So at the end of that 45-day period, you want to have maybe 4 other properties and the DST on the list, just as a backup plan in the event that the other 4 properties don't work out, or the family decides we really don't want to own property outright. And so that's why those DST funds are out there, is for that very reason. It's a passive way to own real estate that still qualifies for the 1031 exchange. That's a misconception sometimes. Someone says, well, our family owns this ranch. We really don't want another ranch. We'd really like to buy a set of apartment complex to have passive income. Great. It does not have to be ranch for ranch or farm for farm. It can be commercial for agriculture. As long as it's real estate, the 1031 applies to real estate for real estate.
So when families are looking to make a transition like this, oftentimes they do need some of the assets out of the sale, the proceeds from the sale, but maybe not all of it. Is there a way to do a partial 1031 exchange?
Absolutely. The 1031 rules simply say that any of the funds from the first transaction that go to an exchange agent and into a replacement property in accordance with these guidelines that we have covered gets tax deferral. Any cash that you receive gets taxed. So yes, if you want to do a half and half or any percentage, that works. Because a lot of times people do need the funds from the transaction to take care of mom and dad long term. So that is a possibility. One thing I am going to touch on though is that 1031s are kind of only fit this certain portion of our taxpayers, because the 1031, the gain on the property needs to be large enough that there is a dire need to avoid the tax. So most of the time the property needs to be several $1 million before a 1031 even comes into the picture. So I just want to throw that out.
So Will, when is the right time for families to bring a tax professional in, and when it's too late, or I guess?
Well, now. So the answer is as soon as possible. Anytime we have a client that has assets, if you have assets, we need to sit down and have a conversation. So at least you're walking through life with your eyes wide open. We have a lot of clients that come in after the fact, and there's just not much you can do when you've already got too little advice, too late. So my advice is, hey, if you even contemplate the fact that you're gonna ever have a piece of real estate or any other asset that's highly appreciated that you're gonna want to liquidate at some point or transition to your family, we need to have that conversation just as soon as possible.
So beyond 1031s, are there other tax strategies for families to consider to reduce their tax burden when selling property?
Absolutely. Like I say, 1031s only fit a very small portion of our clients. Of course, the best reduction of tax is our step-up in basis, which we covered earlier. Let it pass through probate, and you get step-up in basis, and that long-term capital gain vanishes into thin air. Another option is an installment sale. So we have the ability to owner finance a property and spread the recognition of the gain on that property out over the collection of the principal of the loan. So there's lots of factors that go into that, a lot of considerations before we encourage a client to do so. But on a lot of ranch properties, this makes sense. We want to be very careful about, the bankability or the credit worthiness of the buyer. We'll be very sensitive to the tax rate, meaning the interest rate that you charge on the owner finance loan. We'll be very sensitive to the amortization schedule and how long that amortization goes out. We normally like to stay under 10 years to reduce the exposure. And we want to be very sensitive to the down payment, making sure that we get a big enough down payment that we feel insulated as the primary lien holder on the property, that we can afford to repo the property if the buyer defaults. Other ways we can reduce tax besides an installment sale is the timing of the transaction. Your long-term capital gain rate is dependent on your ordinary income tax rate. So somebody that has nothing but Social Security income, for instance, their long-term capital gain rate starts at 0 and then eventually gets up to 15 and eventually up to 20. If someone has a 37% tax rate, their long-term capital gain rate probably starts at 20, and they sacrifice those lower tax brackets. So timing is very important. When you have someone that's retiring, for instance, you don't want your real estate transaction to be in the year that you still had high W-2 earnings. You want to postpone that transaction and say, hey, let's wait till a year where I'm retired, haven't started drawing my retirement yet. I have kind of a lag year or 2 or 5 between my retirement and the time I start pulling my RMDs out of my retirement account. I have some years there that are relatively low tax years. Let's time the transaction accordingly. And then the last kind of strategy that I'm going to touch on is loss harvesting. So anytime someone has a large piece of property that's appreciated, that they're going to have a long-term capital gain on, they can go to their stock account if they have an investment account, and they can go look through all those transactions and have their investment advisor harvest the losses, meaning, hey, in the same year of my big capital gain on my real estate, let's go sell some of these positions that have a loss position. And that allows you to offset the long-term capital gain on the real estate with the loss experienced on your investment portfolio. And then you can always buy those positions back after you wait 30 days to get past the wash sale rules. But loss harvesting is a classic tax planning tool that we use, but there has to be coordination between the investment advisor, the tax preparer, and the client in order to know, hey, how much losses do we need to harvest, and to what extent do we want to buy back to avoid the wash sale rule.
That's fascinating. Something I've never even heard of. Learning you something new right here. So when thinking about making these decisions to liquidate, to sell a property, what else do families need to have in place in order to make this process as smooth as possible?
My pat answer for that is primarily you need a will. Everybody needs a will in place. A dying intestate is not fair to your family. You also need a power of attorney, a durable power of attorney, and you need a medical power of attorney. Those are just boilerplate standards. If a client comes in and they do not have those three things in place, we stop the conversation and they leave and go see the attorney first. Other things that they need to keep in mind is that a lot of times we wait too long and we have properties that are left to the heirs through a will, and the heirs inherit the property as an undivided interest. And as accountants and attorneys, we hate undivided interest in real estate, because if you leave undivided interest in real estate, the heirs all have to sign the listing agreement, they all have to sign the contract, and they all have to sign the closing docs, which means that all three of those things, the listing agent has to be unanimous, the listing price has to be unanimous, the sales price on the contract has to be unanimous, and everybody has to agree to this dispersal of the funds on the closing docs. So that's a challenge, especially if you have multiple heirs from multiple marriages. So we really encourage clients that have real estate, especially multiple parcels of real estate that are not easily divisible through parceling, to think about setting up either an LLC or a trust to hold the real estate. Because with a trust, for instance, you can put the real estate into the trust. The grantors, the owners, can own the property, sell the property, use the property, enjoy the income off the property through their whole life. And then when they pass, that trust becomes irrevocable. And the heirs are the trustees, and they're the beneficiaries of that trust. And the good thing about a trust, unlike an undivided interest, is the trust can name a tiebreaker. So if you've got two heirs that have 50-50 vote in the trust, because they're the trustee of their own trust, and they can't decide, one of them wants to sell and one of them does not, the trust document can include a tiebreaker. So we get rid of this hung jury that happens when we have undivided interest in real estate. And then also what we need to keep in mind is that, historically, estate tax has been a concern for families, the death tax. And, here recently, that concern has somewhat gone away, thanks to the One Big Beautiful Bill. It's now permanent that we have a estate tax exemption for 2026 of $15 million per person, meaning a married couple can have $30 million jointly in their estates and not pay estate tax. So the mistakes that people traditionally have made over time, and that is trying to gift away the land to their heirs before they pass because they're worried about the estate tax exemption, etc. A lot of those concerns have gone away simply by the escalation of our estate tax exemption that is indexed for inflation. So it's going to go up every year from 15 to 16. It's just going to continue to escalate over time. So the number of clients that we have that are actually in need of estate tax planning and estate tax consultations has diminished significantly because of this exemption and the escalation of it.
It's not as complicated as it used to be.
Correct. We used to have these complicated limited partnerships where the parents were gifting their children interest in this partnership to slowly, diminish their estate, because the estate tax exemption used to be $1 million. So there was a lot of people subject to estate tax back in the day. Mm-hmm. And in 2026, that's just not the case anymore.
So Will, what are the common mistakes that you see families make with 1031?
The most common mistake that I see is the asking the question about a 1031 after they've already closed on the property. it's too late for us to even explore a 1031. A lot of people have the misconception that I can go sell my property, and as long as I reinvest in another piece of property, then I don't have to pay tax on it. Well, that's not true, because if you touch the money, if the proceeds come to you, they come into your hot hand, you're going to pay tax on that transaction, because it didn't go directly to an exchange agent to hold it in escrow and then go to the replacement property. The second thing we see often, and we have to go amend some contracts quite often, is that someone doesn't realize that the exchange agent has to be the seller on the property, on the contract. And so our agents get to go amend the contracts quite often, because after they've already got the contract and they're approaching closing, a client will come in and say, hey, what about doing a 1031 on this? And the first thing I tell them is, hey, you need to go now and amend the contract, put the exchange agent, even if we don't find a replacement property. Because there's a lot of 1031s that don't go through. They don't consummate, meaning the 1031 agent is listed on the contract and listed on this as the seller on the closing documents, and the money goes to the exchange agent. And then lo and behold, the taxpayer can't find a replacement property, or decides they don't want to find a replacement property. They choose just to pay the tax. So they can then just contact the exchange agent and request the funds, and then that's just like a 1031 didn't happen.
And Will, I know that you have to identify a certain number of properties at that certain time frame that you mentioned, and then you have to then have purchased one of them over that 180 days. What happens when the properties that you've identified all get sold or just aren't the right choice for you? Can you re-identify something new as long as you're in the 180, or is there any way around that if what you identify isn't available?
Only in the 45-day period can you modify your list. Okay. Which is why normally we encourage clients, if you're interested in 1031 exchange, do not set a closing date for your original property until you've identified and potentially even got under contract. Contingent contract may be the way to go. Until you have the replacement property under a contract, normally a contingent contract, do not close on your property. We want this to be almost a simultaneous close if possible, just so that you don't get hung out to dry by that very thing you're talking about. Is in your 45-day period, you named your 5 properties, you went and looked at them, and you couldn't come to an agreement, or they disappeared off the market prior to you getting a chance to make an offer. So we really like advanced planning. Come in and sit down. Let's talk about the exchange. Let's make sure that that's the route we want to go, or if it's even a potential route that we want to go. Because if there's even the potential for a 1031, it doesn't hurt anything to put the exchange agent on the contract as the seller.
This has been so helpful. We really look forward to going in deeper into estate and financial planning in a future episode.
So Will, for a family that's worried about leaving money on the table, how can they reach you?
They can call my office here and make an appointment. Number's 254-386-8151. Consultations are free. It does not hurt to have a conversation. So I would encourage anybody that thinks they might be subject to some of these concerns, just give us a call, make an appointment, and we'll sit down and talk.
Absolutely. The sooner the better in having these conversations. It's always the right time to sit down and have the conversation before making major decisions. And we certainly, when you call us and you're ready to start talking about the process of selling, are going to remind you to connect with your CPA, and certainly we'll be recommending that you chat with Will at that point.
That's it for this week, guys. Give us a call.